What's up, guys? Rob Jones with Deerwood Capital. Welcome to Financial Sense, where we try to make sense of the financial news. So the two things we're talking about today is one, China, which has been dominating the news cycle, and then two, commodities like silver, gold, and oil. So jumping right into things, article today in the Wall Street Journal, Rethinking Made in China. It's a really good take on China and companies in the U.S. that even before the trade tariffs and tariff war with the Trump administration and Chinese administration, there were these concerns that businesses had because they had these supply chains that were heavily dependent on China. But as the Chinese economy grew and the labor and the people in China got more money to spend, but the Chinese goods stayed relatively stable, the Chinese labor increased, like the cost of labor, and that made these Chinese companies more expensive for U.S. manufacturers to use, and so they've been looking for other suppliers. That makes sense. I mean, companies are smart, right? They also want to be able to diversify their supply chains because if something were to happen, like a war break out with China or trade tariff war, or a supplier, specific supplier, for some reason couldn't come up with demands, they could lean on another supplier. So supply chains and companies are smart. They've always been trying to look for other suppliers within China, outside of China. Even the U.S. makes a good argument because if they need a quick turnaround on a product to get it to stores, then they can just have a supplier in the U.S., which may cost them a little bit more, but the speed to the store is much quicker. And so ultimately, the end consumer, which is us, the consumers, those are the people who matter. And these companies, the good ones, know this, and they're willing to pay a little bit more in order to satisfy the needs of their clients. So basically, going back to the basis of the story in the article, they talk to tangible people, right? Like businesses in the economy, and Yeti is one of them that came up. So the CEO of Yeti said when he got voted into the position of CEO in 2015, diversifying his supply chain outside of China was an initiative for him. And then in 2017, when the tariffs started affecting his primary business, those coolers and tumblers and all this cool stuff that Yeti makes now based out of Austin, they had that become a priority, and now it's kind of been a straw on the camel's back, or a catalyst for other businesses to now look outside of China and diversify their supply chains quicker and faster. So I don't think the tariffs were the original meaning and impetus behind businesses starting to use other companies and diversify their supply chains, but it certainly was a catalyst to really force the issue. All right, so after that, I started reading more about the demand of copper. It's a pretty interesting article because it ties our Chinese conversation into the commodities world. And so what happens here is the title, Copper Lifted by Hopes for U.S.-China Trade Breakthrough. Basically, China and their consumers are the largest country of commodity demand. So if you have these businesses in China who are trying to stay in the supply chain of these U.S. companies, and now these U.S. companies are looking elsewhere and trying to diversify their supply chain and giving them less business, well, then those owners of the Chinese businesses are going to have less money to spend. But as these trade talks come together, now there's speculation that these commodities that go into final goods like silver and even gold for jewelry and even demand for oil, those prices are going to go up because the demand from China, the largest consumer country of these commodities, will be more reliable. Okay. And that will segue into commodities. Now we've seen the M&A heat up for mining firms. Here's another article this morning talking about the rising activity in this underperforming sector. Normally, I don't really like commodities as an investment, like gold, because the only value of gold as an investment is what somebody else will pay you for it. Kind of like painting, okay? It's not a income producing investment. But when people like John Paulson, who's been quoted as a man who made one of the biggest fortunes in Wall Street history, his net worth is $6.2 billion. He runs a hedge fund, and he's getting involved in this space. Even after the mining index tumbled 18% last year and is about 56% below its 2008 peak, it's interesting to see that people of this caliber and the mergers and acquisitions going on in this mining firm space, and following the reasons why that is. So some of it has to do with this China expectations that trade's going to go or get better, and then the demand is going to rise as well, because of a result of that. And it's important to note that this is a long-term perspective, right? So when things are beaten up, it's very cyclical. People think the demand for these commodities will inevitably be lower for longer, but that's not just the nature of business. The nature of business is cyclical, right? So there's flows and ebbs and flows, but the producers of these commodities, they actually own businesses. So they're not in the business of holding these assets. Okay, they're not holding gold, they're not holding oil or silver. They mine them and then they turn them over to manufacturers who build jewelry or refine oil into gas, etc. Right? So that's an interesting business rather than looking at holding gold and silver as an investment or a store of value. And then finally, we're going to wrap up with this Schlumberger CEO expects shale to slow down. So Mr. Kibbsgrad, I won't try and say that again, but he's the CEO. He has said that the budgets of U.S. shale drillers who are customers of Schlumberger could be slightly down in 2019. So if you look at the price of oil recently in quarter four 2019, they have fallen off. Since have rebounded a little bit, but since the price of oil, the price of gold, the price of silver, since those have fallen off, the miners, the drillers for shale, they don't make as much money operating. So they're reactive and they operate less and they pull back on operations, which then, what does that do? It slows down the supply. Okay, so this supply comes down, and then if the demand from China increases or even stays the same, the prices of those commodities theoretically should go up. If there's less supply and the same or higher demand, the supply, the prices should come up. Okay? So that's very interesting because you see it both in the oil industry, you see it in the mining industry for gold and commodities, and then it's all related to really the mainstream media talking about China and then the Trump administration when they're going to make a deal, if they do, what's going to happen with it. So it's a very important thing to follow, and I think as a result, may be interesting to look at the price of oil, what it does. So again, when the price of oil rises, what do you think these shale drillers will do? Oh, just like we saw back when the price of oil shot up in Q2 2018, people run to the Permian basin and start developing operations and investing more in operations as a reaction to the rise in prices of oil. So it's cyclical. Prices of oil rises, shale drillers raise their operations. Too many people start competing. There's a glut in supply. So the supply increases, the price falls, and then the demand will blah. I'm not even going to talk about that. I confuse myself talking about that. But it goes to prove the cyclical aspect of this. Okay. So the price is determined by supply and demand. When the supply shoots up because of these firms that flood the market because of the price, then they oversupply, which brings the price down, and then they follow suit and undersupply, which brings the price back up. So they're always chasing the price. They're always reactionary to the market factors, which nobody knows what the market's going to do at the end of the day. But that's what I came to take away from today's reading. Some other articles that didn't make the list were an interesting article about tax cuts. There's a representative out of New York, Alexandria Oscara-Cortez, I think is her name, and she's saying she wants to put a 90% tax rate on the tippy top tax bracket, so like the top 1%. And the article goes on and talks about why that hasn't really worked in the past, and how the rich usually find loopholes and tax cuts and use forms such as capital gains to never pay effectively 90%. So that goes to show me either she's really smart and is using that as a way to get eyeballs and attract attention, or hell, maybe she believes it, and in that case, I feel sorry for the people who would believe her in thinking that would actually work. The other thing is the Hawaii, whatever, this scandal going on the front page. If you haven't seen it, basically it's one of the largest global manufacturers of gear that goes into 4G and cell phone components. It's a Chinese firm. That's all over the news storm, and here it is in the media today. One of the owner's daughters, the CEO's daughters, is held up in Canada. So I'm not going to go over that, but that just kind of reiterates like everybody's focus is on this one firm, which is huge, and it does touch every country. But there's not always bad actors in China. I'm sure there's a lot of frauds, but there are some good companies, I'm sure. And it's good that Trump is going after China and these IP issues. And hopefully at the end of the day, we'll see some good turnaround there. And then lastly, I think this one was really cool, but I won't go into too much detail because I can't really take away how this will affect the business aspect. This industrial exoskeleton right here, get a look at that. It's pretty sweet. Basically, what I see is that maybe there's an application for these soft AI facilities. When a worker raises his arms, the exoskeleton provides a counterweight to make the arms feel buoyant, and if the upper body is suspended or to make the upper body feel as if it were suspended in water. So like somebody working, like you saw, underneath a car with drills. There's definite applications to that. It's not completely a robot doing all the work. I just don't know how that'll apply in business, and who's going to win, and who's even making those things. They are 4,000 to 6,000, so that's a price range. So that's definitely something to think about in the future. I don't know when it'll come about, but I thought it was pretty cool. All right, well, thanks for watching. I'll see you next time.